Most companies offer their employees benefits. It could be like healthcare, dental, physio, discounts on stuff. One perk that some companies choose to offer is a group mortgage. Not super common, but it exists out there. Not the easiest thing for folks to pull off, but we're going to talk about how this works. Rob McLister is a mortgage analyst, Financial Post columnist, and also the editor of MortgageLogic.news. He is in Naples, Florida today. Hello there.
Hey, Bruce, how are you?
I gotta say, I haven't heard a lot about group mortgages. I've heard a lot about group RSPs and group dental and group pensions and stuff. Tell us about what a group mortgage actually is.
Well, companies are looking for all kinds of ways to retain and attract employees. And so, what they love is low-cost benefit programs. And that's what a group mortgage plan is. And so essentially, these companies offer these incentives to employees, and they work like this. Basically it's, a lender or a mortgage broker pays the company, or the company's employees for the right to do their mortgage. And that might be, like a referral kickback, might be a discount off the mortgage, might be cash back to the employee for getting a mortgage. And these incentives can come from the company's pocket, or they can come from a mortgage seller's commission.
And what would, in the average program, what sort of savings could this amount to? Like, what's the financial incentive for the employee to participate in a group mortgage versus what they'd be able to get by picking up the phone and comparing rates out there?
Yeah, so the group mortgage provider typically markets some kind of discount. And depending on who you're dealing with, that might be a real discount, might be a fake discount, might be a big discount or a small discount. And they also sometimes offer cash back if you're getting your mortgage through the group mortgage plan. And so sometimes the company can kick back a little bit of money to the employee, which is a taxable benefit, which is a whole different discussion. Or you can maybe get a kickback from the broker or the lender that's doing the mortgage, or they might, maybe offer you a free appraisal or something like that.
Why haven't I heard more about this? Is this something that exists, but not a lot of brokers are super keen to participate in?
Well, the biggest problem with group mortgage plans is that not enough companies promote them. So, I mean, it's always worth checking into whether you can get a deal through a company plan. But I wouldn't just, limit my mortgage shopping to that group mortgage plan, because, you got to do your normal research online, talk to other brokers, lenders, that kind of thing.
So we've got an audience that is, people who want to get a mortgage. We've also got a lot of senior leaders who listen to the show who may be thinking about, does this make sense for my staff? Would this be worth my time? What's in it for the employer?
So for the employer, you've got a potentially really cheap benefit that you can market to folks that have a mortgage or are getting a mortgage. And, in addition to these group mortgage plans for like mortgage discounts, that kind of thing, some lender or some companies offer down payment assistance. So they might chip in a little bit to your down payment. And so it's, that's when it starts obviously costing the company a bit more money. But with like a basic group mortgage plan, the company can sign up with a broker or a company that offers them. Like CIBC is a big bank, for example, that really pushes these group mortgage plans. You can sign up with them for like little or no investment.
Hmm. Is there any difference in terms of the product and the features that these group mortgages offer? I ask because if you go outside, you can get variable, fixed, payment vacation, lump sum. Like there's lots of different things that you can include. Is the menu narrower or shorter with a group mortgage?
Well, if there's no down payment assistance involved, then you can, you have a full buffet of normal, your routine lenders to choose from. If there's down payment assistance where, for example, the company is contributing to your down payment, then not all lenders allow companies to contribute to your down payment. Some lenders require that the mortgage be insured. Some big banks like TD allow it with proper documentation on uninsured loans. And, you need the right documentation for that. You need, it's got to show the terms of the down payment assistance, whether it's repayable, non-repayable grant, that kind of thing.
Does it help you get approved? And I ask because typically a mortgage, they look at your income, they look at your, excuse me, your credit score. If you're an employee of this organization, do they bypass some of those checks? Or they're willing to say, wow, Bruce works at that great company. He's got to be a good guy and a reliable bet. Or is the approval the same as anywhere else?
No, approval is the same as anywhere else. Generally, it's basically just a different way to get the mortgage, but you still have to meet all of the lender's lending criteria.
Very interesting. Well, we've got you. I want to ask you another thing that I saw in a recent newsletter that you wrote about, an amortization simulator. Tell us what that even is.
So what we do is we take the very best mortgage rates today. We take the bond market's expectation of where rates are going, and we make a couple of very basic assumptions, like what you could get on renewal. For example, like if you get a 2-year fix, what are you going to renew at? And we use forward rates for that, which is basically the market's expectation of where rates are going to be in the future. We plug all that stuff into a spreadsheet, and then it tells us, on paper at least, what the lowest or the term with the lowest hypothetical borrowing cost is over a 5-year span. And you could compare, say a 1-year fixed today to a 5-year variable, or a 5-year fixed, or a 2-year fixed renewing into a 3-year fixed. You have all these different combinations. So we compare them all. We do amortization calculations for all of these different terms and combination of terms.
Wow.
And then we figure out which one is going to save you the most on paper.
And that's at the Mortgage Logic website. Is that where people find that?
Yeah, that's a tool that we make available to members of MortgageLogic.news. And, it's basically a guide that shows you what could happen if market expectations pan out. And you and I both know that there can be deviations from expectations.
You spend all day, every day, focused on this space. I am sure you are you are a sought after cocktail party guest for Canadians in the process of their renewal, because they want to figure out how to get the best deal, how to make the best choice. What are your top 2 or 3 tips in terms of ensuring that people get the very best possible mortgage for their needs?
Yeah. Okay. So the first thing is you want to get the best rate you can. So you want to shop around online. There's rate comparison sites. You want to call some high volume experienced brokers. If you see, a great deal from a lender, you want to call that lender directly. You want to get the details, not just the upfront rate, but you want to find out what are the gotchas in the contract. If you might move in the next 5 years, what's your portability policy? If you might need more money in the next 5 years, what's your early refinance policy? All of these things can cost you, if you're on the wrong side of the contract, can cost you way more than a small, 10, 15, 20 basis point difference in the upfront interest rate.
How do you think about the fixed versus variable question over time? And I ask over time, people will be listening to this interview a year from now, right? So we can't peg it on the news of the day, but how do you think through that choice?
So mortgage rates are very cyclical. Okay, sometimes they'll be really low compared to the 10-year average. Sometimes they'll be really high. They just came off a big high. And so historically, when they're really high, well above the 10-year average, and there's expectations that the Bank of Canada is going to start cutting rates, and you start seeing the economy slow and inflation's going down, yada yada. Then in that scenario, a variable tends to outperform. And it's the exact opposite at the bottom of a rate cycle. So, timing this stuff is really hard because, just like now, for example, we think rates are going down, but if inflation ticks back higher, it could change everything. And so, but long story short, if you look at that, that 10-year average of prime rate, and you look at where we're at, on prime compared to that, then you can get a relatively decent understanding of whether you should go fixed or variable, or at least you'll understand the risks, the relative risks of fixed and variable.
I mentioned the credit score. It's not the only thing, but it's an important thing. what action would you recommend people take well before they walk into those conversations on renewal to ensure that that credit score is as pretty as possible for the lenders that you might consider borrowing from?
Yeah, so if you have, generally speaking, a 720 credit score or above, you're generally going to qualify for the best rates, other things being equal. That assumes that your debt ratios are in line, you have provable income, et cetera, et cetera. Once you get below 720 or 680, then you start losing lenders, available lenders, and so you may not get the best deal. Now, mind you, there's some lenders that make their very best rates available for folks over 800 on a credit score. So you want to protect that credit score going into a mortgage application. You want to beef it up if you got some debt that you can pay off to reduce your credit score, or credit utilization that can help your score. Obviously, any missed payments in the last few years are a problem for your score and a potential red flag for lenders. So if you have tough credit, something happened in your life, and it was unforeseeable, and you missed some payments and whatnot, you can still get financed. But you might have to go to a non-prime lender, and you pay, anywhere from a point, point and a half, 2 points, plus fees, compared to a big bank mortgage.
Interesting. Rob, thanks for your time and your experience in the world of mortgages. We really appreciate it.
It's always fun, Bruce. Thank you.
Rob McLister is a mortgage analyst, columnist with Financial Post, and also the editor at MortgageLogic.news. He was here to talk about group mortgages and then anything else that I wanted to ask him while I had him here.